Hello and welcome to My Finance Teacher. The year 2017 has only started a week ago, and today I would like to talk about possible future developments, probably for the year 2017, and most likely longer term trends. The things I want to have a look at today are wages. Here we can see the average hourly wage in US. I will also have a look at inflation, bond and equity prices, as well as gold price. We'll also have a look at interest rates on long-term government bonds. So last Friday, early January, US employment report came out stating that average hourly wages over the last year have increased by about 2.9%. That could be interesting, especially in conjunction with looking at some other variables that I have mentioned a minute ago. Let's have a look at inflation. Over the last decade or so, inflation has been in a downward trend, despite the attempts by the Fed and many other central banks in other countries to encourage inflation and encourage spending, and spur inflation a little higher. All those attempts done through QE, quantitative easing, printing money basically, and lowering interest rates. Over the last couple of years, however, we see that inflation has been growing. This is, by the way, the chart of inflation over the last decade. This might not be important, since the growth over the last 2 years has not been very significant. However, if the growth continues, that could be quite important. Specifically, over the last 2 years, inflation has increased from 0% to 1.7%. So in conjunction with this increase in interest rates, to catch up with this increase in interest rates, rates might also increase, and in fact over the last half a year the rates have already increased by more than 30%. Over the last 2 years the rates have fluctuated between around 2% and 3%. This is a chart of interest rates on long-term government debt. So while the rates have fluctuated between 2.2% and 3%, inflation has grown from 0 to 1.7%, which means the real interest rates, the interest rate earnings after inflation, have dropped from around 2% to about 1.3%. So, as I mentioned, to catch up with growing inflation, rates might continue to increase in the future. With increasing rates, bonds are in a precarious, dangerous situation. Over the last few weeks we see that bond prices, this is a chart of the price of long-term government bonds in US, 30-year bonds. We see that over the last few weeks, bond prices have lost quite a lot, and this drop seems to have stopped over the last couple of weeks. Each of these small ticks on the chart is a week. This is a weekly chart, going back over a decade. However, as I mentioned, if rates continue to increase, bonds will continue to drop, as bond prices and interest rates are in an inverse relationship. As one increases, the other must decrease. Generally, with high interest rates, next let's have a look at equity prices. Generally, with high interest rates, equity prices, stock prices, also tend to decrease as financing investments becomes more expensive for companies. As consumption becomes more expensive for consumers with higher rates, demand for companies' products decreases. Hence, with greater rates, generally stock prices as well as bond prices tend to decrease. So with dropping bond prices, with dropping equity prices, investors might start panicking. If not panicking, at least getting worried. They might flee into safer assets. One of those safer assets might be gold. So gold price might be starting its upward trend, and gold price, more interestingly, might have finished this decline over the last several years, since around mid-2011. In addition, if inflation continues to increase, although so far we don't see a great rise in inflation, however, if it continues, that will put an additional pressure on gold price to keep rising. So I hope that these considerations are rather interesting for you. This is of course not an investment advice. This is only an opinion, and good luck.